All right, welcome back. Stocks taking a bit of a breather today, as you see. Some firms now suggesting bonds might be your best play into August and September, not stocks. Mark Okada is the co-founder and CEO of Sycamore Tree Capital, joins us once again at Post 9. Nice to see you back.
Good to see you, Scott.
I'll ask you about that in a minute, but because trade is taking a lot of the oxygen today with the talks in Sweden, you say trade policy being less bad is still bad. You think the market's underappreciating that thought?
Well, certainly there's more certainty now. We know it. We're getting these tax deals, trade deals, whatever you want to call them. They're tariff deals. We're getting the deals done, so that's good. But what's coming out of them isn't exciting me. Even the truce with China at 40%, I don't think that's good for growth. It's not good for consumption. 15% across the board, and then we'll probably get a hike on August 1st. But that's $350 billion of tariff revenue that's coming out of the consumer in the long run. Right now it's coming out of companies, but that's got to go somewhere, right? And so net, I think the market is saying there's less unknown now. We're getting more certainty, and so that feels good. But on the other hand, what I'm hearing doesn't get me excited. It doesn't sound like a positive.
We're too complacent around trade and the impact of tariffs over the longer run? Like the economy, what looks good today might not be such tomorrow, so to speak?
Well, let me put it this way. I think signal to noise ratio is horrible. There is so much noise. It is very difficult to pull signal out of the market. But if you go back to January 1 to now, inflation's about the same. Labor market's about the same. Earnings are still positive. There's not a whole lot of big signal that would tell this market it should be down a lot or up a lot, and it's kind of rebounded and gotten back there. So if you're just looking at signal and what we've gotten, it's okay. But I think it's weakening on the edge. I think some of the data we're seeing out of labor starts to concern me. If you look at the employment numbers come out and there's surveys. And every time those surveys come out, it looks strong, and everyone says, hey, the labor market's fine. But then the next month it comes out, and the prior month we were off by 100,000. We were off by 50. They've been off every month this year to the negative of about 75,000 on average. So there is some weakening under the surface, and those signals probably start to show up. And I think complacency might not be the right thing, but it's certainly the market needs to react to that.
The credit signals, if you want to continue to use that word, were flashing yellow for a little while.
A little bit, yeah.
But they've calmed down.
Well, dispersion's up. So credit's this asset class that is very defensive. We only make money when we get our money back. We get a coupon, we get our money back. There's not a whole lot of upside in credit. Mm-hmm. We've talked about this before. I'm a pretty bearish sort of person in general. And
that's why you're in credit.
Yeah, that's what we do. But if you look at the names that are exposed to the industries that are mostly China, mostly hit by tariffs, those names are down 5-10 points. You're not escaping it in the credit markets. But on the surface, I mean, Scott, we're being pulled along by the equity markets. Credit's not leading in here. I mean, credit is high and tight, and there's not a whole lot of risk premium everywhere I look. The market is wide open. Activity is high. The CLO market that we're in, issuance is up probably 30-50% over long-term averages year to date. So markets are open. This is good. They're operating. But it's like on the edge, it's starting to feel like we should be more defensive in our thinking as opposed to offensive.
But that's why I said earlier, there was that moment where credit was leading the equity market.
It's not now.
And it's not now, but does it have, if not the last laugh, does it have another fit that we need to pay attention to when we get more focused on the outcome of what the tariffs are going to mean, and then we're more fixated on now that the taxes are done, what the deficit's going to do? How do you think of, and what the Fed may not do? I don't know.
Well, bringing up the Fed, my interpretation of all this pressure that Powell's getting is that Trump's not ignoring all of the disruption that he's doing all over the globe. And he knows that he probably would like to have some insurance against that. So a rate cut in here, to me, might not be a positive, a bullish rate cut. We might get a bearish rate cut. We may have something where the Fed thinks that they need to ease because the labor market's weakening. And that would certainly be something coming out of the bond market something coming out of the rate market. At the same time, we just finished with a bill, and the Treasury has to restock their coffers. So now that the debt ceiling's gone, they're issuing a ton of T-bills, and they're probably going to do some twists to try to stop, longer rates going up. But all of that sucks liquidity out of the system. I think that feels to me as one of the reasons why we've had all this great news coming out from Besson and everybody, and the markets have kind of sit there. They really haven't done a whole lot. They bounced back up, but even today is a good example. It's like, okay, nothing bad out of China, but
well, there was nothing good. There was